Hello, welcome to the latest in this series of Allsop PropChat podcasts. I'm here today with my City and West End partners, Chris Room and Nick Pemberton. My name's Ed Dunningham, and today we're going to talk about the West End and City markets. So without further ado, Chris, how have you found the markets over the last 6 months or so?
Hi Ed, good to be back. Yeah, no, look, I think we'll start with just some stats really, just to throw at you. So I think in terms of the city, in the last quarter, we've seen about 400 million of transactions. That's between July and September. Typically Q3 a slightly quieter quarter, which is 20 deals, average lot size of about 21 million. Which is relatively low, I guess, in the context of what we have historically. In 2017, for example, it was over 90 million as an average deal size. In the city, that brings the year-to-date totals to around 2.45 billion, over 61 transactions. So we've seen a consistency there, really, in terms of number of deals per quarter, but a slightly lower quarter volume in Q3. Putting this into a bit more context, so we're ahead of last year already by September, which is good. So we're about 200 million ahead of the final year volumes for 2024, but a fair bit behind 2023, where we had 3.5 billion across the year. So it might be that we catch up to 2023 before the end of the year, given what's under offer, but we're still a bit behind. And then in 2022, for additional context, we were over 7.5 billion. So which was slightly above the long-term average. So we're still low in terms of volumes.
Okay, so, steady progress. In terms of the sentiment generally, how do you see that sitting at the moment?
So sentiment, I think is getting better generally. There's definitely more liquidity in the market. There's more confidence for vendors to test the market for sales. But I think we are still struggling a little bit with the larger lot sizes in the city. We had a few larger deals over 100 million going through in Q1, the likes of your 100 New Bridge Street, 1 Port Soken Street. There was a fair bit of Japanese capital that came into London at the start of the year. It's still there, but where we've suffered has definitely been that upper end of the transactional limits, and we've only really up to about 6 transactions over 100 million this year so far, which is more than last year where we only had 4, but less than the previous year where we had 8. So, we're still really struggling with these larger deals. And what we've seen as a result of that is the Japanese money particularly has been buying into shares of buildings. So we've seen a couple of 20% shares of here and 25% shares of something else and 50% shares. So, and I think that's what's allowing vendors to preserve their yield, is selling a share of a building rather than the entirety. So, and as a result, the lot sizes are lower.
Okay, well, before we go into the whys and the whos, let's just check in with Nick and the West End and how the picture sits there.
Yeah, I think the West End is a quite a different story. So Q3, we did 1.07 billion of deals. Average lot size is around about sort of 40 million, 26 transactions. And I think contrasting to the city, what we've really started to see is these bigger lot sizes, not only coming to market, but sort of trading. So I think this year so far, we are 9 deals over 100 million. For context, in 2023, it was 7 in total. But that doesn't really paint the full picture. I mean, there's a lot going on in the West End, which we'll come on to. But just putting it back in terms of volumes for the year to date, Q1 to Q3, we are at 3.7 billion, which is almost exactly the volume for last year. 2023 was 3 billion. But we're still some way short of the 5-year average is 5. The long-term average is kind of 6.5 almost. So, at 3.7 billion for the year, we're still some way behind volumes. But I guess the second half of that story is really what's happened in the last few months. I think since the start of August, we've tracked around sort of 40 deals been brought to market. There are quite a number of large lot sizes. I think we counted 12 deals over 100 million have been launched or are sort of being launched. So some big lot sizes in there. And I think the fact that some of these lot sizes are now trading, we are seeing renewed investor confidence in bringing these larger assets out.
And do you think, I mean, I suppose one of the features of the market that we've seen over the last year is that difference in expectations from buyers and sellers. Is that, who's coming together here? Is it the vendors lowering their expectations, or is it the other way around, the market getting stronger and meeting those expectations?
I think it depends on the assets, but I think in a lot of cases what we're actually seeing really is that the buyers are moving much closer to the vendors' original pricing aspirations. There's a building 1 Newman Street, which is under offer to Royal London, which GPE are selling. And they had that on the market 18 months ago. And I think my understanding is that the yield was sort of nearer, it's 260 million now, sort of 4.3, 4.4%. And 18 months ago, that was probably nearer 5.25%. And GPE quite rightly elected to hold it. And I think in assets such as that, what we're really seeing is this really strong rental growth in the West End. But, is actual evidence is actually happening. So we're sort of starting to see people looking at their return requirements, running their IRRs, etc. And your buyers are, putting some fairly steamy rental growth on, which is, proven already, onto these numbers. And therefore, they're able to get to this sort of pricing. I mean, it's not the case in all markets, but really rental growth has been a big driver. And I think, the West End, it's back and it's leading the charge. I'm not saying it's easy to do deals still. There's a lot of forensic detail that goes into them. But, we're going to probably, if there's $1.5 billion under offer and 3.7 billion traded, even if those deals happen and not another deal happens, we'll still hit the 5-year average. But with the other stuff that's gone under offer, we should see a decent number of, big deals happening. So although in context, if we've had 9 done this year, in 2017 I think there was 26 done over 100 million, so still a long way to go, but yeah.
So sentiment is clearly a lot better and the deals are happening.
Yeah.
But who's in the market, who's in there investing, spending this money?
I think it's probably fair to say, certainly in some of the sales we've been involved in, that the depth of buyer is probably double what it was a year ago. We're regularly in this sort of magic zone of the sort of 20 to 50 million lot size. We're regularly seeing double digits in terms of number of bidders. And it's a real range. You've got the US PE money. There's a lot of that still washing around. We've started to see some Japanese money coming in, I suppose, with cheap cost of capital. But I guess the one other interesting trend is that the funds are back. They've put offices back on their shopping lists. Aberdeen are currently buying an asset. Royal London, Crown Estate obviously have come in, but things like Staffordshire County Pension Fund buying the biggest asset they've ever bought, a 50-odd million pound building in Victoria. DTZI buying for one of their local authority pension funds. CBRE Capital Advisors buying for RBKC pension funds. So we're in that sort of, typically 40 million lot size. We've got a lot of the UK funds back in, because if they want offices, they want to come back into offices and add some weighting to their office portfolios. The West End is, at the moment, the most liquid, most sensible, probably the best rental growth prospects. A great place to start. But, we've also, you can't ignore the likes of the Norge, who really this year, with their stakes in Shaftesbury and Grosvenor, they're responsible for nearly 25% of the volume.
A couple of big deals at the beginning of the year. And so just coming back to Chris, I mean, obviously there's a lot more optimism over there. How does that bode for the city, do you think?
Well, I think we've got some, as Nick described, a situation before with Royal London. I mean, the one barometer that a lot of people have been looking at was the sale of the Can of Ham, which has been going on for quite a while now in terms of the ongoing saga and change of buyers. And actually, that was, we were talking about Blackstone acquiring that at a yield of around 6%, probably on our last podcast. Since then, it's gone back under offer. The yield is now 5.8%. It's about 340 million. Caprion fronting Hayfin, who are a big sort of European money manager. And that shows, I guess, an improved sentiment for a larger lot size, albeit one that has been in and out the market and, there to do for quite a while. I think with the city, what I think that suggests, you've got a rental growth story in the city, not as strong as the West End, obviously, but around the main transport hubs, around the Crossrail hubs, Liverpool Street, Moorgate, Farringdon particularly, there is a very strong rental story. And I think what we're seeing right now is that location is just so much more important than anything. And anything that's sort of in the EC3 and Insurance District, EC2, around Bank, any those central core city locations, it feels like there are buyers for that. And, if it's not today, it might be next week or it might be in a couple of months. There is a liquidity, piece that is very, very potent for a core city asset. It's not the same for some of the fringe markets. Clerkenwell suffered, Shoreditch has suffered, albeit around, the northern area around Liverpool Street. We'll see, a natural push, I think, over the next few years as Liverpool Street starts to lease up. But that occupational piece is very important for the core city. And I think that's why we're seeing some of these buildings like the Canningham. Largest deal this quarter was a building on Cannon Street, 110 Cannon Street, which again was on and off the market for a little bit. It's traded at a strong price to a Middle Eastern group, but it's right opposite Cannon Street Station, the new entrance to Bank Station even. So that location piece is very important. And I think for the city particularly right now, we are seeing things eventually trade, eventually find their price if they're in a good location.
I suppose the other dynamic to look at is the cost of building or replacing some of these buildings. The Canningham is selling for what?
About 1,000, 1,100 on that one. But you're absolutely right. It's to actually build that now would probably, on a net basis, exceed that by the time you've factored in all your build costs, and your GIA are going to be in the 500s, and then your SIL and your planning costs and everything else. So you're absolutely right. And I think that's, we seem to be getting more and more money looking at, you call it core plus, but it's buying in where the capital value is in line with replacement cost or almost below, and that the investment value is in line with the replacement cost or slightly below the replacement cost of the asset.
On that, if your build cost all in is the price of buying that asset, that completely ignores land price, developer's profit, finance. It basically is the raw build cost with Cat A, fit out, etc. It's that you're buying some of these assets at the build cost rather than the total cost.
Yeah, and real estate is a long-term game in a sense. If you're buying income today, there will be a residual value to that building. There'll be a residual value to the land. I mean, we had our first major land deal this quarter, which was the Row, which Stanhope and Cheney bought down on the South Bank. But the rental potential of that building is so strong because you're right on the river. You're facing the North Bank. We've seen some really strong rents achieved in Southwark if you're on the river and if you've got river views. There's been some, it's quite a unique occupational market down there because it's very, on the river you get the very, very high rents and you falls away very, very quickly. But to have a sort of a land deal go through, which obviously they're very sensitive to exit yields and to rents and to build costs, is quite encouraging, I think, because, you would call that part of town, very much in line with the city, I guess, in terms of rental potential. So I think that's encouraging. But at the same time, to buy an asset where you can buy it with income that you don't need to build, and you're getting a yield day one, provided you can, as Nick says, get your IRRs to work and, you're sat on an income stream that's sustainable for the next, 5-10 years, however you want to own it, there'll be a residual value to that building at the end. And we think that's where, certainly in the city at the moment, where your cap vals, people tend to get a little bit nervous over £1,000 a foot, but it's going to get beyond that with where rents are going. There's some opportunity.
And do you think, obviously, the rental growth picture has been established? We saw this sort of earlier in the year, and it's certainly a big driver of the market. Is that continuing? Is it just still very much focused on the prime end of the market, or is it widening out at all?
So I think there's obviously different rental growth, or there should be different rental growth percentages for different stock. I think the prime end is where we're seeing the big numbers. And it was double digit last year in terms of prime grade A new stock. And the point being, really, there's just been very little development, and there's been people that have been able to refurbish buildings, but there's been very little new development. And as a result, as these large occupiers are moving around and deciding they need new buildings, there's just less and less of that space. So I think rental growth will continue in that prime grade A space. I would say on the secondary space, it's less. I think grade B particularly, I think some of the fringe markets are challenging, and I think then you have to look at the building and you have to look at the micro location and see whether there's an appeal to a certain type of tenant. But I think there's going to be an increase in what people are coining grade A minus, where it's not quite your £100 a foot plus and your tower space rents. It's going to be a good quality building in a good location that might have had a majority refurb, and it's well positioned, very functional. But a tenant can go in there and doesn't have to pay super prime rents. And I think we will start to see, certainly in the city, more occupiers moving into that kind of space. There'll be more deal evidence. There is already more deal evidence of people moving into buildings or tenants moving into buildings where they're not paying the top rents, but it's still, that's being squeezed. It's squeezing out a number of occupiers into the sort of tier 2 buildings, so to speak.
So occupiers are being forced to look at the second best accommodation, I suppose.
Exactly. Yeah, it's just a function of the lack of development, really, I suppose.
Interesting. And the West End, how's the growth picture in terms of rents there at the moment?
I think again, it's the best of the best is we're hitting £200 a foot for big floor plates in a couple of examples. There's a lot of pre-letting activity going on, so there is a real concern about running out of space. I think our agency teams also recognise that a lot of occupiers are deciding to stay put for another year or two. There's still a bit of uncertainty around that. It's not all plain sailing. We're definitely, as Chris says, we're starting to see the sort of value engineering where occupiers can move but not be paying the top rent. And I think there's probably an acceptance of that. But back to sort of Chris's point on the sort of crossrail nodes, etc., and transport hubs, that is pretty key for occupiers still. And but the rental growth story is a pretty strong one across the board in the West End, in the sort of core locations.
And I think with that, Ed, an interesting stat for the city is over this year there's been about 34% of the volume has been owner-occupier purchases.
Yeah.
And that's of the total volume this year, and obviously greatly skewed by the 100 New Bridge Street acquisition. It's interesting, we're seeing a regular churn now of tenants looking to buy their own building rather than move. And on the other end of the spectrum, I think we'll start to see tenants staying in their building, but the landlord's contributing to a programme to sort of work around them. We've seen that on a few things where they'll take a longer lease, but a landlord will give them a nice generous rent-free period and help contribute to their capex for a nice refurb. And I think the more cost-conscious, larger occupiers will be doing a lot more of that as well.
Yeah, I think that's right. We've seen a lot of owner-occupier activity in the West End. In the West End, you get the extras, so you get Miu Miu on Bond Street being bought by the owners. Half of Bond Street now is owned by the retailers themselves to sort of protect themselves the rents. But 11 to 12 St James's Square, Larry Ellison buying that asset, 3 St James's Square being bought by a part owner occupier. We're seeing a lot of people wanting to own their own buildings, and I think we were talking about it in the office the other day. Why is that? And I think one of the functions is, you can regularly see some of these occupiers going in and spending on their Cat B, on their fit out, $250, $350 a foot, completely redoing space. Citibank in Canary Wharf are a great example where they're putting in however many staircases to create villages and spending, I don't know the numbers, but I would suspect it's £300, £400, £500 a foot on their fully sort of refit of their building. You're better off owning that asset rather than spending the money on someone else's building, I think. So there's definitely a real trend towards that.
Okay, so sentiment is definitely improving, more so in the West End.
Yeah. There's
particularly a growth story coming through on rents that continues, which is fantastic. Money rates, of course, have been fairly static. The 5-year swaps, SONIA swaps, fairly similar over the last sort of 6 months or so. I suppose the only respite is that a number of the banks, you're seeing the margins coming in. The banks are getting really competitive, so that's making debt cheaper for people. Is that a function? Do you see that in the market at all, in terms of helping people to pay a bit more?
Yeah, look, I think you look at a deal like Worship Square in the city, which is quite it's a very, very good brand new redevelopment by HB Reavis just north of Liverpool Street Station, arguably a couple of streets too far north, I think, for some of the international capital, but Hines are buying that asset. We understand the pricing's probably going to be somewhere between 5.75% and 6%. Now at that level, as you say, Ed, the swap they haven't really come in enough to sort of justify a high margin. But I think because there's not that much happening and there's a lot of money raised to lend, I think the banks have been, from what I hear, quite aggressive on that particular purchase. So they're offering, an attractive margin, which then means that an asset like that, where you're getting nice long secure income, good location, probably a little bit in the rents longer term because of the fact that we've seen a lot of rental growth in that area, it starts to look probably quite accretive for them as a purchaser. So I think you're absolutely spot on with the lack of, I guess, transactional activity has meant there's a lot of pent up demand to go and put money into some of the better quality assets, certainly over in the city where we are still seeing, yield trades in the, I guess in the mid fives plus. So yeah, for sure. We just need more stock.
Indeed. Okay. One area we haven't covered yet is who the vendors have been. Nick, do you want to?
Yeah, I mean, I think we've seen quite a bit of land securities, which we mentioned earlier, have obviously sold the biggest asset sale this quarter, possibly even this year, is them selling the Ministry of Justice building on Petit France to Aurora Hotels for change of use to hotel use. They've also got a couple of other assets out in the market, land securities. We've also seen the likes of GPE coming out with Wells and Moore, or about to come out with Wells and Moore, which will be a couple of 100 million lot size. Interesting. And then the likes of Hines, who are really, I guess, buy, fix, sell. They're refurbishing buildings, redeveloping them, and then selling them at the end of business plan. They've got the Berlin under offer. Continue to see Hong Kong money selling. Interestingly, for the first time in a while, we've seen Global Holdings, who own quite a number of really good quality buildings. They've started to look at selling some of the sort of their, what they would argue, non-core assets. So they've got 210 Pemberton Road on the market, but the Abu Dhabi Royal Family, Berkeley Square Estate, Beam, are going to be bringing out 72 Welbeck Street, which I think it's going to be 160, 170 million lot size. So I guess they probably need to fund their development of 33 Cav Square. But people who you'd think wouldn't traditionally be selling are starting to bring assets to market.
Yeah, I think Nick mentioned Landsec. I mean, they've 3 of our deals, of the 20 deals for Q3 were Landsec sales in the city. So they seem to sort of culminate in a Q3 exchanges and completions, which was Row 1, a building 22 Southwark Road, which went to a hotel group, and 140 Aldersgate Street, which JP Morgan bought for a value add play. So Landsec certainly are at the top of that list, really, and. But I think in the city still, if I look down our list of sales, there's often a strategic piece there. It's either, coming to the end, towards the end of a fund life, or maybe, they don't have any appetite to do the business plan. We've still got the Asian ownerships of buildings, Chinese owners that are, thinking, we want to repatriate some capital. So there's a building on Moorgate that sold recently to an owner-occupier, which was a Chinese owner. And it went very, very well. They managed to reclaim almost all the money I think that they bought it for pre 2020. So there's been a bit more of that as well. I'd say sort of the Asian money sort of that doesn't have the appetite to spend a lot of or invest a lot of capital in the building, looking to sell as well.
So just to wrap up then, favourite deals of the quarter?
I'm not going to necessarily name one specific one, but we've seen. I always think. Freeholds in a garden square, you can't go wrong in the West End. There's a very finite supply of these buildings, things like 11 to 12 Hanover Square that are where Super bought. Great asset, really good quality. I think garden squares probably have a premium, particularly if you can buy a corner one, because there's even fewer of those as long as they're freeholds. So I'm going to dodge the question slightly, but say if it was my money, I'd be trying to buy a freehold in a garden square.
Okay.
Yeah, look, I thought about this a little bit before. I mean, I looking down our list, I quite like a deal that Mazabi did on Seckford Street it's just off Clerkenwell Green. It's a beautiful building. You've got effectively government-backed tenants in there. They paid about 9%. Actually, sorry, I correct myself there, about 8%. But you've got a little bit of income to the government that seemed quite quite committed to that building. It's a beautiful building, but it's a single let building, so there is going to be some difficulty if they do go. But it's a sensible cap val. It's a nice pitch on Clerkenwell Green, and it's a nice yield. And I just think that's quite a smart deal. And I think you can get some real yield on buildings where you've got reasonable income at the moment. And I think this is the thing: is it really 8%? Is it 9%? Is it 7%? And on something like that, where you've just got the one tenant for a number of years, it's quite clear what you're getting, and I think it's quite a smart deal.
That's great to hear. Well, certainly Central London is improving, liquidity is there, and no, that's good to hear. So just to wrap up then, lasting thoughts to finish the pod.
Yeah, I think, look, the West End is kind of back. West End usually leads, as I said earlier, and if we've had more than 3 billion launched since August, we've hit last year's total, and we've got 1.5 billion of assets under offer at the moment. So that should take us to the sort of 5-year average. But there's a lot of assets been launched to market, a lot of which are really saleable stock. I think West End could finish on a high in terms of volume, and liquidity sort of has significantly improved, and number of buyers has probably doubled over the last year.
Yeah, look, we hope what we've seen in the past is that the liquidity in the West End then feeds down to the city. I think the city's a very interesting market to buy into right now. Before, we hope there is more liquidity from the vendor's side, or the confidence to be able to put brochures out to the market with buildings, over 100 million. And I think we will see that. But I think, from us, we feel it's a really exciting buying opportunity still. I think sellers are a little bit more now in tune with where the market is, depending on where the building is located, and there's more transactional evidence to benchmark that off. But look, we think it's a very exciting time in the city, and certainly those opportunities where you can buy in at replacement cost, buy an investment at replacement cost, I think are quite exciting.
That's great to hear the positivity from you both. That's it from us, and thank you for listening.
Thanks.
Thank you, Ed.